This is the weekly economic and market update for the week ending September 23rd, 2022, and looking forward to the 26th. And it has been a rough week. Um, we've had everything's gotten beaten up. I am extremely happy. I did a series of bear put back spreads that if they with the expectation that things would go up, and they went down, but I made a little bit on the down and closed out a lot of those positions today because the market just got destroyed. And short term, we've just about hit a double bottom in almost all the markets, except the Dow actually went lower than it did in June. So my expectation right now, at least the 3 to 4 month time frame, is I'm 80% bullish, 20% bearish, and 0% neutral. And I know you're probably thinking, well, why are you 80%? Well, we just had a huge drop. Now it can fall more, and I expect it to drop more soon, but not yet. um, that doesn't mean I'm going to be right. I'm more often wrong as far as directional things, and that's why I do back spreads and straddles and strangles, which strangles right now are a little expensive. But well, so are the straddles too. But so they have to move a lot in order for them to perform. But I got into it when the VIX, the volatility index, was much lower. So, this is the way I protect myself. I do have, as I've mentioned before, a lot of in my portfolio that is longer term types of things that I just hold. They're usually dividend paying stocks or stocks that I expect will last over time. That's my personal sentiment. The investor sentiment this week, we are at Wednesday, and you got to believe that these numbers have changed since then. But Wednesday, close of the market Wednesday, 60.9% of investors were bearish. Now, I went back because I wanted to see, in essence, just kind of looking here, what the if I went back in time, was there any time that people were that bearish? And what I found was that on October 9th, 2008, it was 60.84%. And I think this was 60.9%. So, that was the second most bearish number, the 60.84, which now this one removes that from the second most and becomes the second most bearish time since they've been keeping this record. And the highest bearish time was March 5th, 2009. Now here's kind of when I went back and I looked, because I wanted to see what was happening in the markets during that time period. And what had happened was that for the 60.84% or whatever time period, it fell. The market wound up falling another, 30-40% from there. And then the time it was 70%, which is the highest ever bullish sentiment, it actually doubled over that time period. Is investor sentiment the way to go? According to that, 50-50. So, as a contrarian investor, it's one of the gauges that I look. There are other things I look for, but this is certainly one of them. And that's why my expectation, at least short term is you're going to get some type of bounce off of where we are. And like I said, we may be at 70% bearish now because this was taken on Wednesday, and today, the market was down as much as 800 points today, Friday, and it ended up, I think, in the high 400s. So there you go. The thing that caused all the chaos, the federal funds rate. The Fed met. They raised it 3/4 of a point, which should have been a surprise to no one. And if they had 50% or something less, then that would have had the markets probably skyrocket. And if they'd gone a full point on the federal funds rate, beyond where they are now, but beyond 3/4 of a point, then I think that things would even fall in further. And that's the nature of the market now. And you hear people say, don't fight the Fed, and right now that seems to be playing out, and they have given super negative guidance with regards to saying, hey, there's going to be a lot of pain. We put you in this situation, but we're going to give you some more pain. And just kind of makes you mad that they didn't start addressing these issues back in after the great financial crisis. And this is going to get ugly, and we'll talk about that in the commentary. So let's take a look at the 10-year Treasury. Now, it got as high as over 3.8% at one point. Let's look at 5 days today. And, my expectation was it would stay below 3.5%. And it might be starting to revert right now, but I keep hoping. So it hasn't happened yet. And as those rates go up, everything's inverted. The 2 years doing 4%. And then the further you go out, the lower the yields are as far as Treasury notes. So the 2 years and is got a higher rate than the 10-year, and all of these are negative for whether we're going into a recession or not. I think that's pretty much baked in. It's going to be how bad, and in my opinion, this is going to be a depression. Not today. We're in a recession right now, but tomorrow, it's tomorrow. And when I say tomorrow, sometime next year, we're going to be in a world of hurt. So that's a 10-year. And again, you'd think this thing would start to turn over, but when we look at some of these other things, you'll start to get a different picture. So the DXY today. So this is the US dollar. It spiked up over 113, and it doesn't appear to be rolling over. Look at the momentum on that thing today. The bar is very long. Brent Johnson's Milkshake Theory. It's starting to look like it's going to happen. And if the Milkshake Theory is what happens, and with the Fed's attitude type of thing, Brent Johnson says 150. Gets to 150. The wheels will be falling off of stuff. It's too bizarre to me. And I think that, then the yields play into this. So my expectation again is that some of this stuff has got to start to roll over. It's all you can see in the RSI, which is the relative strength index. Anything over 70 is overbought. But maybe not. And with that momentum, it may just continue to climb. And, right now it's kind of saving us from even worse inflation numbers, because a strong dollar means that we can import goods for less, even though we don't necessarily pay for them. We just give them IOUs and then inflate away the money. But so that's the DXY. Now, part of the good news, I guess, if there is any silver lining, is the crude oil prices have gone down. They were under $80 today. For you'd have to go back a ways. This is a weekly chart. you know, this is back in January when it was under $80. Expectation, at least in the short term, is that this will continue to get crushed down because of demand, that things start to slow down. And well, I think they've already started to slow down, and we'll look at some other figures. But it's a mixed bag, I have to say. It's shocking how the economy has been able to withstand, and the consumer and a bunch of things, incredible headwinds here, and it's just going to catch up with us. So, I took a look at the GDP. It was negative 1.6% first quarter, negative 0.6% second quarter, and this quarter is on track for a 0.3% improvement, gain. But we still have a week to go, and again, my expectation is that number will continue to go down. 30-year, and this is one of the reasons why, the 30-year Treasury, 30-year mortgages up to 6.29%. Now, people my age will know, I think my first mortgage was like 11%. I don't remember what it was, 10, 9 maybe, some special deal the builder gave us. But, when you go from 2 to 2.5 range, and you go to 6, that's a shock. That means you're paying, two times plus, what you would have been paying just a year ago. So it's getting expensive from a mortgage standpoint in today's terms. And so this is going to, how's it played out? Well, again, mixed bag. United States housing starts. After going down to 1,404, the expectation was it would be something lower, like around 1,445, and it came out at 1,575 on the high side. So that's good news. People are doing housing starts. Then you go look at building permits. It was down. It was expected to be 1.61 million. It was down to 1.15 million. And then we look at existing home sales, which it's continued to drift downward, but the momentum that it had seems to be dying out at this point. Now, do I think that'll change as the mortgage rates continue to go up and Powell's wanting to basically kill the economy? My expectation is yes, and that's kind of what he wants to see. So mortgage rates will continue to go up. 10-year continues to go up. It kind of has 10-year. It has a mind of its own, so it may still reverse, but he's got it pretty well convinced that he's going to keep the rates up higher. So let's take a look at next week and see what we have coming up. We have durable goods orders that will be an indicator on Tuesday of next week. We've got new home sales. That's being reported next week. And so it's not quite as active a week, but there's always something that come out that will shock people. Personal income, personal spending, all of those things are important, from a standpoint of, what's going to happen economically as we move forward. So, my commentary again this week is going to be, how long can the Fed keep this up? For every percent that they increase the federal funds rate, that's another 300 trillion in interest or billion in interest per year. So at some point, all of the tax receipts that the government gets, they're not revenues. I hate that word. They're not revenues. They're tax receipts. They're taking from us to spend somewhere else. And the tax receipts, the debt, payment on debt at some point becomes higher than the tax receipts. So, you know, it's out of control. I don't know whether the Fed has thought that through. I'm hopeful that they have, um, but I I don't see it unless they say things and then they reverse things and they're staying committed type of thing. The whole election thing certainly went out the window because they're tanking the markets with their actions and the economy. They being the Fed, and there's starting to be some pushback, but at this point, unless they come out of sequence, you can plan on them continuing to raise rates the way that they said that they would in their post FOMC remarks. So something is going to break. If the dollar continues up, um, something will break and it'll start to reverse itself, at that point. But I don't know what's going to break. The global economy starts to break. If China's in trouble, uh, um, most economies are in trouble right now, including our own. And the higher these rates go up, the Fed funds rate, um, the fewer dollars that are out there for other countries, and they're all investing their capital here. And right now, that's the way the federal government wants it. But the timing of this might work out real well for the Republicans, um, because they've just tanked the markets by virtue of the action and their guidance moving forward. And I was a little surprised at the guidance piece, and I think that's what got the markets this week, because I wouldn't have thought they would come out so strong right before an election. So, economy is a big issue for voters, and I think that is something that the Fed apparently they're not taking into consideration unless they do some last second thing here. Maybe they watch the markets, crash like they have the last 3 days, and we're at lows right now that we were back in June, which is the lowest that it had been in a long time. Actually, and the Dow going below that June low. So it's a weird market. I personally am kind of letting the dust settle now. I got out of a few of the back spreads that I had that where I expected things maybe to go up, and instead they hit the back end, and I make more when it would go up than on the back end. But I made a little bit, on those back spreads, and so for me they wound up being right for my portfolio. It doesn't mean it's necessarily right for yours. But this is the thing I want people to understand: is got to start educating ourselves on what's happening in the economy. And I know everybody's got 1,000 things to do, but this is something that it's there's huge opportunity, and there's also huge risk in this environment. And I, once it completely crashes, then there's going to be lots of opportunity uh, at that point. So that's trying to play it as safe as I can on the with these back spreads and with these straddles and strangles, which, like I said, with the VIX so high right now, the premiums for options are very high. But it's time to start looking at what stocks are going to do well after the crash, and I still think there may be multiple crashes. Will there be the melt up that I had really hoped for? It's not looking very good right now. So that's why I said I'm going to let the dust settle, and if it continues down, then I'll just wait and keep my powder dry. So that's it for this week. And looking into next week, Should be a quiet week as far as economic activity reports, but there's always something that surprises. So I will continue to monitor this and see what things are coming out. But it's incredible. But again, I still think that people need to be up to date on these things. And know kind of at least a little bit of what's going on, what tools are available to you, what's your risk level, all the things, that I've put in some of my initial, planning out. What do you think? Are you Keynesian? What's your philosophy, your narrative for investing? So that's what I wanted to cover this week. And remember, there is always a better way.